Hello fellows, welcome to my channel. This channel is created for educational purposes only, dedicated to people who want to learn how to trade. Either you want to trade stocks, crypto, commodities or Forex. You will find high quality educational material. Either you are a beginner, advanced or an intermediate trader. For viewers that want to see more action and how we apply the theory in real trades, you can visit our live channel. Here we are trading our live account and applying the theory, proving that it can be done, while all trading profits go to our subs. However, as a beginner, I do not recommend starting with any real money. Trading is very risky and challenging. However, a risk comes always with a reward. You will find 50 videos to understand the theory, 12 sections. Each section is a playlist consisting of several videos. I do not recommend skipping chapters and trying to take classes from the beginning. We are using verified sources to provide the most accurate information. Remember, this is an educational channel and you will always trade with demos to avoid the risk. Make profits in the market is not the easy passive income you have in mind. The entire material is the same as you will find in most trading courses. The material is totally free and you don't have to pay any guru to learn generic information or waste thousands of dollars. So if you want to support us, subscribe, like and leave a comment for the YouTube algorithm. And you can post your progress in our Facebook page. Thank you very much and trade safe. Elliott theory, the only scientifically proven methodology that describes the market's behavior best. The market consists of recognizable repeatable patterns. A pattern inside a pattern. Mathematical fractals describe this behavior best. In this episode we are analyzing the Elliott wave theory, by far the most important theory you need to know before starting trading. Of course, nothing is perfect and there are several flaws of this theory when it comes to applying it to your trading. It will take time to master, but I can guarantee is the most efficient method. You will find an amazing video from one of my mentors, Bill Williams, regarding fractals, and also we will do a separate video to cover the specific topic, as the market loves to travel through prices with less resistance. Without any further ado, let's start from the beginning. The Elliott wave theory is a theory in technical analysis used to describe price movement in the financial markets. Ralph Nelson Elliott was an American accountant and author. He studied the stock market and the data led him to develop the wave principle. In the early 1930s, Elliott began a systematic study of 75 years of stock market data, index charts ranging from yearly to half-hour prices. In August 1938, he detailed his results by publishing his third book in collaboration with Charles J. Collins, entitled The Wave Principle. The golden ratio again was there, but we will return to this, so stay to the basics. The theory is based on collective human behavior and how this behavior is being depicted in market price behavior. According to Elliott, the market is being traded in repetitive cycles. These cycles are driven by emotions of investors. The upward and downward swings in price caused by collective psychology. The same repeatable pattern. These upward and downward swings are being called waves. If you can correctly identify the repeating patterns in prices, you can predict where the price will go. Elliott waves is what every trader needs to grasp. Elliott came up with a system that enabled traders to catch tops and bottoms. In this chaos in prices, Elliott found order. The Elliott wave theory was created. We need to make a small reference to fractals, even though we will study them in another episode, but for the purposes of this video, we need to make a fast intro. What are fractals? Fractal is a pattern that repeats forever. Every part of the fractal looks very similar to the whole image. Fractals are structures that can be split into parts, each of which is a very similar copy of the whole. In Elliott waves theory, we have repeatable waves inside waves. By zooming in the market from the longer periods to the smaller ones, we see the same market behavior. Impulse waves are followed by more conservative correction waves, main trend and retracements. The theory identifies two main types of waves, impulse waves and corrective waves. The Elliott wave theory consists of a 5-3 system of a wave pattern. The first 5-wave pattern is called impulse waves. The second, a 3-wave pattern, is called corrective waves. In the corrective waves, we will see the ABC pattern. So, 5 impulse waves and 3 corrective waves. Impulse waves 1, 3, and 5 go along with the overall trend. Waves 2 and 4 are the corrective, opposite of the main trend. The first wave starts with a strong move in a direction, indicates that the previous trend has ended and a new trend has emerged. The first wave has been caused by a small group of people that decide to enter the market. This causes the prices to rise or fall depending on what side of the trend you are. Initially, it can be hard to identify this wave, and we do not trade it as it is unstable. Because if the previous trend was bearish and you see an up move, it still might be a retracement of the major move. This is one of the major flaws of this theory. It is really hard to identify the first wave. Initially, it will look like a retracement. Now, as a rule of thumb, and what we suggest is to check how strong is that move. Strong moves will indicate a breakout from the previous structure, usually prolonged periods in one area of prices. Again, unfortunately, there is no way to know for sure. Anticipation in the market will finally create the impulse to buy. So the first wave is being created. Wave number 2 is the first pullback from the first wave in the opposite direction. These waves are smaller in duration. People who were the original buyers decide to book some profits at that level. This causes the prices to take a small retreat. The retracement won't be lower than the first move, as this would violate the basic wave rule we will see in the following chapter. The buyers are diving in the market earlier again, so the prices retreat a bit, but now they are willing to buy again. The third wave is starting. This confirms the strength of a trend, and it is usually the strongest one. Now in the third wave, most people are willing to enter the market again, as the prices are going higher. During wave number 3, is when most market participants will realize that the previous trend is over and will now follow the new trend. This wave exceeds the high created at the end of the first wave, but again, it comes the moment that most traders will cut their positions. The faith is being lost and most traders will decide to book some profits. The market retreats again, and the fourth wave is being created. Wave number 4 is another corrective wave in nature and signals that the best part of the trend is over. Wave number 4 is difficult to count and may take a long time to develop. Again, should not be longer than the previous wave, the number 3. This wave tends to be weak because there are usually more people that are still bullish waiting to buy the dips. As the prices retreat, euphoria is in the horizon from people from the previous waves. Now the fifth wave is about to start. This wave marks the last burst of buying before a new trend starts. Eventually, after all, buyers are exhausted and the prices loses momentum. This is when the assets becomes overpriced, and then the ABC pattern emerges that we will see in the next chapter. The impulse waves won't have the same length. According to original Elliott's theory, it's usually the fifth wave that is extended. However, this change in time, and by experience you will notice that most of the times the third wave will be the longer one. Again, statistically speaking, the third wave is the one we want ideally to trade. Corrective waves, also called diagonal waves, consist of 3 or a combination of 3, ABC, as we mentioned. These waves are corrective waves to the main trend. The market and most of the buyers or sellers are being exhausted at these levels and take a breath before deciding to enter again the market. Many new traders might confuse the ABC with corrective waves 2 and 4. I know that it is a mess, and the reason is that you need to be an experienced trader to start identifying the waves in the market. And of course, this will pay off, as it seems that eventually the chaotic markets will start to make sense. We are using letters instead of numbers to track the corrections. According to Elliot, there are 21 corrective ABC patterns, ranging from simple to more complex ones. This is where this theory becomes hindsight. We will make another episode for more advanced traders to go deeper to this analysis and of course some real trades we took before the market makes the move. You don't have to memorize all 21 of these corrective ABC patterns because they are just made up of 3 very simple, easy to understand formations. These formations are zigzag formation, flat formation, and triangle formation. In the flat, you will also find some subcategories like regular flats, expanded, running, and also double 3 or triple 3. However, we will stick to these 3 basics: zigzag, flat, and triangle formation. The zigzag formation are very steep moves in prices that go against the main trend. Wave B is typically shortest in length compared to waves A and C. These zigzag patterns can happen twice or even 3 times in a correction. 2 to 3 zigzag patterns linked together. Each of the waves in zigzag patterns could be broken up into 5 wave patterns. A wave inside a wave. The flat formation. Flat formations are simple sideways corrective waves. In flat, the lengths of the waves are generally equal in length. It will look like a multi-top or bottom, with wave B reversing wave A's move, and wave C sets off wave B's move. Wave B can sometimes go beyond the beginning of wave A. It doesn't necessarily mean they will have the same length. The triangle formation. Triangle formations are corrective patterns that are bound by either converging or diverging trend lines. We have analyzed triangles in this series, but now by combining with Elliott theory, you will become pros. Triangles are made up of 5 waves that move against the trend in a sideways direction. These triangles can be symmetrical, descending, ascending, expanding, and I suggest to check triangles episode. Elliott waves are fractals, formations inside formations. This makes them hard to identify, especially for new traders. 5 waves move in the direction of the main trend, followed by 3 waves, a 5-3 move as we described. This 5-3 move then becomes 2 subdivisions of the next higher wave move. So we see Elliott waves inside Elliott waves. In simple words, the same 1, 2, 3, 4, 5 ABC pattern that makes up the basic Elliott wave can be seen in some form or trend as you zoom in and out. Like a babushka doll zooming into the market, you will see the same formations. Keep in mind that each wave is comprised of smaller wave patterns. This pattern repeats itself forever. Elliott waves theory has assigned a series of categories to the waves, from the largest to the smaller ones. His research over 70 years gave the below categories: 9 degrees or waves from largest to smallest. Number 1, grand supercycle, multi-century. Number 2, supercycle, about 40 to 70 years. Number 3, cycle, 1 year to several years. Number 4, primary, a few months to a couple of years. Number 5, intermediate, weeks to months. Number 6, minor, weeks. Number 7, minutes, days. Number 8, minute, hours. Number 9, sub-minute, minutes. A grand supercycle made up of cycle waves, made up of primary waves, made up of intermediate waves, made up of minor waves, made up of minute waves, made up of minutes, made up of sub-minute waves. The key to success is to establish rules. For most new traders, creating a mechanistic set of rules will take time. Goes without saying that we need them also here. There are 3 rules for the Elliott theory. First rule, wave 3 can never be the shortest impulse wave. Rule number 2, wave 2 can never go beyond the start of wave 1. Rule number 3, wave 4 can never cross in the same price area as wave 1. Sometimes wave 5 does not move beyond the end of wave 3. This is called truncation. In impulse waves, the truncation is formed as an impulse or diagonal, and in diagonal waves as a zigzag. A truncation in the 5th wave of leading diagonal is extremely rare. 5 wave price movements in the opposite direction confirms the truncation. Wave 5 can go beyond or breaks through the trend line drawn of wave 3 parallel to a trend line connecting the start of wave 3 and 5. Wave 3 tends to be very long, sharp and extended. Waves 2 and 4 frequently bounce to golden ratio levels. When you have a clear sight on wave 2, you must shoot the market. One of the major drawbacks of this theory comes to the application. Unfortunately, in the beginning, you will start identifying waves everywhere. Again, this will take time to master. For me personally, it's the only theory that provenly makes more sense. The first thing you need to identify is a trend. It's very easy to make scenarios when the market already did the move. As we said, this is the reason you need to start with several demos. Applying in real accounts is not recommended until you get enough experience. So here are the steps. The first step is to identify the trend. The second is to highlight some swing highs and swing lows. Try to identify without bias some straight average lines that crosses the prices. Will help you see the waves more clear. Waves do not look the same. Always use it side by side with an MA Bollinger or ribbon so that the values will make more sense in the given structure you are about to trade. The market might not do 5 waves but 6, 7 or more. Get ready for your golden ratio retracements. Ideally we want to identify the third wave, but that's not easy. The key to success is to identify the main trend and the retracement. For your exits, use golden ratio and always try to secure some profits. A very simple example of real trade on our account on Bitcoin, as it's relatively a new market, and for me personally, the third wave has started. Again, trading real money is forbidden. For your exits, keep in mind the rules that we said. Waves must always not violate previous waves. We talked about the exceptions. The Elliott theory is one of the hardest theories you can master. It will take time to do so, and a lot of practice. The market initially will look like there are waves everywhere. An experienced surfer, however, will identify the correct wave and will ride it to the end. Market psychology is being better described with these Elliott waves: euphoria, fear, panic, and so on. The market consists of behavioristic patterns, and that can be seen in prices. The aim of Elliott wave model is to allow us to find the point of an upcoming reversal. By knowing when a market forms a top or bottom, you would be able to place your buy or sell order and profit. By correctly identifying the repeating pattern in prices, it would be possible to predict where the prices will go next. It is a leading indicator, if we could use that term. Finally, something that can predict future prices. The disadvantages of the Elliott wave theory is that it's very subjective and it's quite difficult sometimes to pinpoint the beginning or end of a wave in a 5-wave cycle. With a lot of practice, one can get better at recognizing this pattern. The huge drawback of this theory is the time it will take you to master. The main advantage is that Elliott is the most powerful tool in your trading kit. Thanks for watching. Go back, repeat the chapters you are not sure, and trade safe. So that's it for now. Thank you for watching our videos. I hope you enjoy. You know that we need your subscriptions, likes, and comments for the YouTube algorithm. Help us to make more content and trade safe.